Good evening, everybody. My name is Daniel Young. I'm the owner and founder of Adapted Perspective and the Adapted Perspective social media platforms, and I am back to talk about closed-end funds and investment strategy as we continue to both invest in the market now, but also just as we continue to play the long game. This is an unedited video. Who knows what you'll hear in the background as I film these in my house. My cat is currently sitting next to me peacefully. We'll see if he makes an appearance. I'm not a financial advisor. I am a financial strategist, and I don't speak like the herd. I walk in limited company, and sometimes I walk alone. And I also try to be as transparent as I can. So I'm maintaining my outline in the sense that I have a basic outline of just like from top to bottom, but at the same time, I have no notes. I'm attempting to be as off the cuff as possible. And quite honestly, the more I read, the more I realize that, how to say this well, not so much, maybe not well, but in an organized manner. Um, Everybody has a different opinion about the market. I am very opposed, or maybe very of a very different strategy, very different thought process than what the market at large is saying. Very different strategy and overall opinion of how we're investing now compared to how we're investing, like the overall long-term strategy. I mean, the goal is to build a portfolio that uh, we can rake dividends on instead of selling off our principal or selling off our portfolio every year. The goal is to either supplement or fund a retirement based on dividends and not sell off the portfolio and sell off more than the portfolio than what's really being advertised in a very poor reverse dollar cost averaging situation. And the bulk of the financial marketplace, um, the bulk of the opinion regarding the financial marketplace, especially the stock market, 95% of people have no idea what's going to happen. There's a ton of speculation. There's a hope, like a giant pile of bad advice. Um, and the bulk of that, I don't want to say misunderstanding. It's not a misunderstanding. It's just they cannot grasp how things are going to go. And bare minimum, they can't interpret the current data and then forecast a reasonable outcome between the between President Trump's stance regarding taxes and tariffs, the incoming Treasury Secretary. Uh, you have the deep state swamp fighting for life uh, with all the USA drama and how that's impacting everybody's market confidence. You have core inflation data coming out. Um, you've got just overall market sentiments about a potential trade war, or at least trade war or tariff war. Um, you've got the tech, uh, say the tech battle from last week. What we didn't truly see a tech dip, but we saw like a like the divot or a dimple on a golf ball um, with that OpenAI stuff. Um, you've got oil coming back online in the sense that we're going to, if the USA is truly going to be energy independent, we're going to start drilling a ton in a lot of different places. And then, depending on import and export and tariffs, either let's say consumer goods, and you look at the energy transfer across the earth, as well as uh, let's see, consumer goods, energy transfer, and I had something else to go with that. Uh, Maybe just global funds in general might not be the best investment right now. So the best overall take on the market I've seen is from Brett Owens. So I'll display that, and then you can pause the video if you want. If I can get my mouse to work, you can pause the video and review. Come on, review what he was saying, or at least what he said. If I can get that out of the way. So this is from a recent article from Brett Owens, and it makes the most sense. Um, it's still very much a bond market, or at least a bond proxy market. Now, pending your take on proxy, meaning, so if we look at proxies like real estate, that's reasonable. If you look at the proxy of utility and energy transfer, maybe that's not so reasonable based on tariffs. If you look at oil, that's kind of in its own class. Tech is dependent on oil. So with more oil in production, tech should get cheaper, but everything should get cheaper with more oil. I mean, more oil impacts our everyday lives to the point where you just don't realize it. I mean, oil and its derivatives, so tennis shoes, furniture polish, furniture stain, furniture sealant, tires. I mean, the obvious gasoline, all that stuff. But like refrigerator parts and laptop parts and pacemakers and AC component, like everything in our modern lives, whether you're off grid or like if you're off grid and living on solar, solar is an oil byproduct. It takes oil to make your solar panel. Without oil, you don't have a solar panel, or your solar panel costs more because there's less oil to go around. So oil impacts everything. So more oil, which is going to take a while to come online, but more oil means the cost of everything should go down. But in that, technology in theory should go down in theory because there's more oil to do all the other stuff. But with the tech surge, we'll see more utility and LNG draw. And depending on where that's coming from, if it's a tariff issue or a tariffed item, you might see a price increase or a price change on that. So outside of Brett Owens, I haven't seen a reasonable take on the market, one, between tariffs and inflation and bonds. And I also have not seen a reasonable uh, extrapolation of how that impacts the market at large. So if it's really a bond market or a bond proxy market, what are the best things that we can buy in this current market? Well, we can look at that. Go back to sharing my screen. My mouse will work. So I've already looked at the closed-end fund master and pulled out the targets onto this tab of the spreadsheet. And we still want to concentrate on monthly payers. And I've changed the targets at the top a little bit. I sectioned out oil and tech. They're related, but right now they're different. And then we have utilities, energy transfer, consumer goods is over here. So the top targets are in this color green. The mid targets are in this color green, depending on what you can find. And then consumer goods, I'm not a huge consumer goods fan. It's too volatile a market space for me. So since all of these are top targets, they're all significantly discounted, with the exceptions being the not all the municipal bonds are, let's see, they don't straight meet the discount metric. However, I'm new to municipal bonds, uh, and Brett Owens talks about these all the time. So I left them on the list based on his categorizing, despite them not meeting my categorizing. But I'm new to this, so I'm very willing to take his advice. Um, but outside of that, everything else meets the metric. Um, let's see, blue we own, purple recommended, green I track for any number of reasons. I have not color coded our recent portfolio developments at Fidelity, but I mean, on my end of things, I'm trying to consolidate funds a bit, so or at least consolidate um, investment platforms. That's probably a better way to say it. I'm trying to house everything under Fidelity. Um, so as that takes time to, and I'm honestly waiting on Webull to do something. It was something simple. It should have been done last week, but in 5 days they haven't fixed it. So if I can get them to fix it, then I can hopefully transfer those accounts under the Fidelity umbrella and really try to consolidate everything under one platform. Um, but anyway, color coding aside, so we want to focus on monthly stuff. So they're all significantly discounted outside of a couple municipal funds. They're all monthly payers. What we want to target, come on, are yields. And then, and this mouse is just not feeling it. Um, we want to query. So the municipal bonds are a little, they're subtly different. So like this has an obvious 7% yield. However, it's got a slightly different yield based on your tax bracket. But I don't want to add anything different than what we currently own. So these three municipal bonds we currently own. HFRO will stay simply because it's the most significant discount. And then of what's left. So utility, I've not heard a lot about this company. And I get the discount, I get the yield, like it is all utility investments. I've owned an Allspring company before. I'm not a huge fan. Um, it's just not hasn't convinced me to buy it. DNP, I like it, I explained this last week, but it's a discount based on its overall pricing. However, I still have a hard time buying premium. One, two, it pays a fantastic consistent yield, but at the same time, the yield never changes. The yield changes based on price, but the actual dividend, like it's a consistent dividend across several years. They have not raised it at all. Let's see. So you have a global fund, global funds, global funds. Uh, Technology is tempting. It's $2 more than what we currently have it for in the Roth portfolio. Um, it also has a dividend that has not been lifted, and the goal is 9% or above, unless there's a good reason to pursue something else. Like HFRO, the reason would be it's 54% off. So, for gosh, if you're going dollar for dollar, like if it's a 0% discount, then you're spending a dollar for every dollar invested versus this one is 54% off. So you're spending 46 cents for every dollar invested. In NBXG, the discount's gone back up. The price slipped a little bit compared to the beginning of the week or say the end of last week. But at the same time, it's what you want in the market. Like you want your assets to go up in value. Um, and at the same time, it's up in value. So is it a decent consideration? Yes. Will it make the final cut? No. Um, let's see. TEEF, I can get that through BRW. CIF is good in the sense of a bond company. The PDO is a bond company. I still like the FCO better than CIF because it's got the BDC component. River is not a full municipal bond. HCLB has gone up in price, but it's a decent portfolio if you want a mix of things. But if we're going to crazy target, so if you're going to try to target, I'll hover back. So if you want a smattering of things between bonds and real estate, utilities and energy, HCLB offers that. But if we're going to truly target bonds or real estate and not a smattering kind of portfolio with a can scenario, this is bonds and stocks. I mean, they pay a fat dividend. Uh, River, nope, wrong way. So we're left with this. So you end up with bonds and stocks, and also a new, and also, so BRW is an activist fund. It's bonds and stocks, but they own a ton of closed-end funds. They also own they own crypto. Um, that's an interesting take of things. You've got bonds and private investing or private lender, which would be a BDC, right? All tech heavy and 5G, all real estate, and then municipal bonds. So if we're going to streamline or be extremely particular or extremely selective uh, in what we're focusing on, like this light green is the higher focus than this other stuff. So gosh, it's a hard point. It's a hard pick. So if I was buying in our Fidelity platform, I would honestly just duplicate what we had from the last time we bought, which ended up being, come on, mouse, which ended up being this. Bought 7 funds. There we go. I would just duplicate that from the Fidelity account. If we're buying for the Roth, and we aren't, but if we're buying from the Roth, municipal bonds in the Roth don't make sense. Municipal bonds, you get tax-free money. The Roth is tax-free money as it is. Just doesn't make sense. So of the options, that's a $2 premium. If if tech actually had their bubble popped, like tech is overpriced in general. If the tech bubble actually popped for any number of reasons and it dropped maybe 10%, I would be interested in that, regardless of what the new buy-in price would be, because that would be an actual discount on the overall value of the tech market. So that leaves us with 3 good options. HFRO because the discount, I mean, their yield hasn't changed, but again, it's that portfolio restructure. Uh, God, it's the discount. I mean, really, uh, cheap buy-in overall on their real estate portfolio that is still coming online. FCO, I mean, it really it's not a coin toss in the sense that you don't have you have a triple-sided coin in the sense that you have the heads, the tails, and the edge. Uh, but any of these would be a good option. BRW activist account, bonds and stocks, plus the crypto component. Uh, FCO for the reasons I already said between the bonds and the private lending, and then HFRO on the real estate. So if we're picking in the Roth, we already own all three. Um, the dollar cost average move, I think, is HFRO. Let's see, FCO increased their dividend, and I still like what BRW is doing. So it's really a hard pick to pick one of them because I can argue for all of them. I don't know if I can pick one. Um, let's see, if you forced me to do it, I would pick this one simply because the discount window has closed. They've raised their dividend. They're positioned well to raise the dividend again. Uh, actually, they've actually scheduled a shareholder meeting for next month, but they FCO seems to be positioning themselves to be able to further invest and develop their company with this new with the new Treasury Secretary and the new uh, honestly pro business, pro tech, pro I don't want to say pro taxpayer, but pro business and pro individual environment we're seeing in our country. Uh, HFRO will have more stuff come online. I think they're well positioned. And then BRW, I like their format in the sense that it is an activist, but it's a shareholder, it's a pro shareholder activist account. So I could argue for all three, but if it really came down to it, I still think I would pick FSCO. Um, but again, we're not buying tomorrow. And we just bought our first round of funds in Fidelity 2 weeks ago. And on the Roth end of things, I'm patiently, attempting to patiently wait to see what happens in the market overall based on ZTR and GLO. But with the global funds and the tariff systems and who knows how that's going to go, I honestly don't know how that's going to go. Like they're earmarked at a certain time. They have these hybrid bond accounts that honestly should be doing pretty darn well for what's in each of these accounts. And at the same time, they're not, which is pretty frustrating. So I can either continue to ride the roller coaster and see where it goes, or I can just sell them and call it and go from there. And quite honestly, I don't have a good I don't have a good bearing on that right now. Uh, we still have about 2 months to add into the Roth for last year's amount and then start on this year's amount. So we have time, but at the same time, it's kind of like I bought these funds knowing they were roller coaster or kind of or they were bounce pattern funds in the sense like every 2 to 3 years they go up and then they go down, they stay down for 2 or 3 years and go up. And it's been 2 or 3 years for both, and they have not gone up to previous level, and that's frustrating. That's like I bought them knowing I would ride the roller coaster, and it yes, it's impatience, but it's also trying to figure out if it's just the time to sell and call it a day, or if it's worth it to try to ride the roller coaster. So we'll see. Overall, we go back. I mean, overall, it's a hard pick for me. It really is. Uh, between real estate, bonds and BDC, and then bond stocks and crypto. Um, I can argue for all, but I think at the end of the day, it's still going to just be FSCO because yeah, rising dividend, closing window on the like this window's closed a little bit, that window's closed a little bit, but this one has shrunk considerably. So it's not quite the FOMO scenario. It's not quite the fear of missing out, but at the same time, with a shrinking window and an increasing dividend and the potential to increase that dividend more, um, I would pick this one. So maybe that is maybe it's heads, tails, and the spine after all. Maybe. But either way, that's all I got. I don't want to talk in circles. I don't want to drag down your, I don't want to make a longer video than I need to, and I don't want to waste your time and listening to me waffle back and forth about any number of things. So that's all I got. If you like the content, consider subscribing to my channel. Hit the like button because it really does push videos out. And if you want to find me day to day, you can comment on these videos. I am still on Instagram and Facebook, but I'm still working that out long term. My focus now is, I mean, my two focuses now. My one is it's working on my reasons for closed-end fund investment, whether by, quite honestly, by short ebook, but then also our overall 12 steps to financial freedom system and figuring out writing the books for those, but also figuring out the best long-term platform system and service to use. So uh, if you want to talk about closed-end funds, comment on the video. If you want to see the 12-step system overall, you can find me on Instagram under the same handle. And then you can find me on Facebook under the group is called Navigate Your Finances. So that's all I got. Whatever you have for the week, I hope it goes well. Whatever your strategy is your strategy. Just my advice would be to invest for the long term, right? Play the long game because it really is worth it. Don't buy into, gosh, don't buy into whatever the herd is listening to, wherever they're getting steered. The best answer, the best solution is generally opposite of what the herd is doing. Um, so if you don't have a strategy, figure out your strategy, um, and then yeah, where to start really is the best advice I can give you is to figure out your strategy and how you're going to invest and be able to invest based upon that strategy and be able to explain it to somebody else why you're investing based on that strategy. They don't have to agree with you, but you have to be able to articulate your plans. And if it doesn't make sense, like if you're blowing smoke and stuttering your way through it, you got to figure out a better strategy or at least improve that strategy. And then all of your investments become related to that strategy. And if it doesn't make sense for your strategy, then either A, you need to adapt it, right? Or B, you're trying to convince yourself to do something different and you're not being true to your strategy. So figure out how you're going to invest and then invest. Uh, and if that differs from me or differs from the herd or follows the herd or whatever, just make it based upon your strategy and not just what some random person's telling you. So whatever you have for the week, I hope it goes well. And if you want to chat closed in funds, then by all means, leave me a comment and I will see y'all on another video. So have a great week, everybody. Oh, mouse troubles in general. But have a great week and I will see y'all later. Bye.